Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we are looking at assets and liabilities. Now we've touched on these briefly before and today we will look at them in a little bit more depth. And we'll start with classifying assets. Now accounting books will be divvied up into a variety of different types of categories. The first being current assets, and these are those assets that the business expects to realise within 12 months after the reporting period. So if a current asset shows up on the accounts, it's expected to be used within 12 months. And on the other side we have non-current assets, and these are assets which the business expects to keep for a period greater than a year, greater than 12 months. So 12 months is key. Non-current assets is divided up further into property, plant and equipment. Now these are assets that are held for the use of the production or supply of goods and services or for administrative purposes, and they're expected to be used for more than one accounting period, for more than 12 months. Investment assets is another class of non-current assets. Now these are assets which earn revenues for the business, but they're not the main revenue. The main revenue will come from selling the goods and services. So these assets earn revenue, they're not the main revenue producing assets of the firm. And examples are shares that the business may own, government stock, or term deposits. Term deposits which for a longer period than 12 months. Another class of non-current assets we call these intangible assets. Now these are assets which we can't touch, they've got no physical presence, but they represent a right to something. They're untouchable. Copyrights, patents, trademarks, etc. Current assets.
Current assets are assets that the company could convert into cash within a year in the normal course of business. Current assets include cash, accounts receivable, inventory, marketable securities, prepaid expenses, and anything else that can easily be turned into cash. Current assets are used to calculate financial ratios, such as the current ratio, which divides current assets by current liabilities. To see any company's current assets, just look at its balance sheet. John owns a small publishing company. Here are what his company's current assets consist of. Cash from sales, $30,000. Money in checking and savings accounts, $50,000. Short-term investments, in this case U.S. Treasuries, $50,000. Accounts receivable, or payments the company is waiting to receive for publishing services sold on credit, $20,000. Inventory, $0, because John publishes ebooks and does only print-on-demand for paper and hardback books. Prepaid expenses, payments for services John's company expects to receive in the near future. These include rent, $0, because John operates out of a home office, $2,000 in professional insurance premiums, and $10,000 in taxes. Total current assets, $162,000. Not included in John's current assets are items that will not be converted into cash, sold, or consumed within a year, such as John's computers, office furniture, and the value of his solid reputation in the publishing world.
Intangible assets.
Intangible Intangible assets don't physically exist, yet are valuable because they represent potential revenue. Take an intangible asset like brand recognition. There is value in people remembering your company and then wanting to buy its products. Another type of intangible asset is intellectual property. Intellectual property includes legal rights such as patents, trademarks, and copyrights. Intellectual property has a fixed lifespan. Because of this limited lifespan, intangible assets are amortized and thus fractionally expensed over their legal lifespan. Rocky Star is a famous guitar player and owner of Rocky Star Productions. Rocky Star Productions owns a number of intangible assets. One group of intangible assets is the copyrights to all of Rocky's songs. Another is the brand recognition associated with Rocky's name, which Rocky was smart enough to trademark. Rocky also invented a guitar sound effect, which he patented and licensed to a third-party manufacturer. Owning the copyrights, trademark, and patent gives Rocky Star Productions the ability to receive multiple revenue streams. The company receives revenue whenever one of Rocky's songs is purchased, played, or performed. No one can use Rocky's name on a product without paying for that right. And whenever the third-party manufacturer sells one of the guitar sound effects, it pays Rocky Star Productions a royalty. While none of these assets have a physical aspect, clearly they do provide a future financial benefit for Rocky Star Productions and thus are included in the balance sheet.
Property, plants and equipment, probably the main source of business assets.
Property, plant, and equipment, or PP&E, is the term for an asset account on a company's balance sheet. As the name suggests, the account includes a company's land, facilities, machinery, office equipment, vehicles, furniture, and fixtures involved in actual operations. Generally, PP&E investments are not easily liquidated. The value in the account must be adjusted periodically to reflect the current value rather than the original value of the company's physical assets. For example, the investments in plant and equipment must be depreciated annually to show that these assets decrease in value as they age and are used. On the other hand, investments in property may move up or down in the short term, according to real estate market fluctuations and general economic conditions. However, over the long term, property investments normally increase in value. Some types of businesses tend to have large PP&E accounts. For example, a shipping business will have a very large PP&E due to the high value of the ships it owns. A consulting company may have very small PP&E if its consultants work primarily on laptops in a leased office.
Let's have a look at some further examples of assets within the asset classes. So assets can be divided up into current assets and non-current assets. Current assets, that are expected to be owned for less than 12 months. Non-current assets for greater than 12 months. Non-current assets we know can be divided up into three classes of assets. So these will be itemized under these classes of non-current assets in the balance sheet. Investment assets, property, plants and equipment, and intangible assets. So let's have a look at some examples now. Current assets examples are money in the bank, accounts receivable, these are our customers who we expect to receive money from, petty cash, which would be cash kept on business premises and used for daily expenses, and inventory or stock. Investment assets, shares in other companies, term deposits, greater than 12 months in the bank earning interest. Property, plants and equipment, land, buildings, vehicles, furniture, equipment, etc, etc, etc. The main class of non-current assets for the majority of businesses. And intangible assets, examples here include goodwill, and this is the business's reputation, its brand image, etc, etc, etc. Patents, copyrights would all be prime examples of intangible assets. current liabilities.
Current liabilities are company debts due within 1 year or one operating cycle, whichever is greater. An operating cycle is the time it takes a company to purchase inventory and convert it into cash from sales. Current liabilities include items such as accounts payable, short-term debt, and taxes payable. They are handled separately from long-term liabilities, which include long-term borrowing, bonds payable, and long-term lease obligations, which are due in longer than one operating cycle or 1 year. Current liabilities are usually derived from operating activities and are expected to be paid with current assets. Examples of current assets that are used to pay current liabilities include accounts receivable, inventory, liquid assets, and cash. Having an optimal amount of current assets to pay current liabilities is necessary for good cash management. Analysts usually measure this with two metrics. 1. The current ratio. This is the result of current assets divided by current liabilities. A result greater than 1 means there are enough current assets to pay current liabilities. A result less than 1 is a red flag for analysts, as it means there are not enough current assets to pay current liabilities. 2. Working capital. This is the result of current assets minus current liabilities. It shows investors and analysts the excess of current assets over current liabilities of a company. While it is always good to have more current assets than current liabilities, too much working capital could be a sign that management is not handling current assets effectively. If Smart Readers Incorporated has $5 million in cash, $10 million in books as inventory, $6 million accounts payable, and $4 million in short-term debt, its current ratio is 1.5, and its working capital is $5 million.
And non-current liabilities.
Long-term debt is any debt or liability that is due in more than 1 year. Long-term debt is a category in the liabilities section of a company's balance sheet. The types of debt usually considered long-term are bonds, loan agreements, and leasing obligations. Commercial paper and repurchase agreements issued by a company are not long-term debt because their maturity is less than 1 year. Assume ABC Company has a loan from Big Bank in the amount of $5 million. The terms of the loan require ABC to pay back $1 million a year for the next 5 years. During the first year, ABC issues a balance sheet. In the liabilities section, $1 million of this loan will be listed as short-term debt because it is due within 1 year. The remaining $4 million will be listed on ABC's balance sheet as long-term debt. The long-term debt section of the balance sheet is important to analysts trying to determine how well a company is using leverage to enhance profits. It also helps them determine the company's solvency. For some companies, long-term debt is a burden to be avoided. For others, it is an accepted way of doing business. For that reason, comparing one company's amount of long-term debt to another's is only useful if those two companies are in the same sector or industry.
So just as with assets, we were dividing them up into current assets and non-current assets. We're dividing liabilities up into current liabilities and non-current liabilities. And again, it's on the basis of that 12-month period. Anything less than 12 months, we talk as being a current liability. Anything 12 months and over, non-current liability. So our definition for current liabilities are those liabilities that are due to be settled within 12 months of the reporting period, and non-current, those that are due to be settled beyond the 12 months of the reporting period. Examples of liabilities: current liabilities and non-current liabilities. Examples. So current liabilities examples include a bank overdraft, accounts payable, and loans that are due within the accounting period. And that may include a portion of the loan. So again, we saw in the video, that if the business has a bank loan of up to 5 years, but each year it has to pay off $1 million, then that first year the current liability will be $1 million and $4 million will appear under non-current liabilities within the balance sheet. Now, examples of non-current liabilities: hire purchase, mortgage, long-term loans that are due in more than 1 year's time. So 12 months is key for both assets and liabilities, dividing them up into current and non-current. Now we need to be able to identify assets. So whether an asset is okay, it's important that we're able to identify which items are assets and which are liabilities. So an accountant has to be able to identify whether a particular item in a transaction is an asset or a liability, so that they can prepare the balance sheet, that statement of financial position, accurately. Now, to do this, we're going to focus on the same characteristics of each definition and justify how the asset or liability meets the characteristic of that definition. Now, the definition, the accounting definition for assets, are those resources which are controlled by the business as a result of past events. So past events is key in getting through in your definition, from which future economic benefits being key again, that's why it's highlighted, are expected to flow to the business. An asset is made up of these three main characteristics. So future economic benefit. Usually the future economic benefit will be income that the asset is going to be used to produce. It's got to be controlled by the business. That means that nobody else can use the asset to earn the income or receive a future economic benefit. And an asset comes into being as a result of a past event. This is how the entity came to have control over that asset. And that sounds a little bit complicated, but usually the past event is the company bought the asset, being the past event. Now, similar thing and when identifying liabilities. Here's a definition. Liabilities are present obligations, that's key, of the business as a result of past events which are expected to result in an outflow of resources. But those outflow of resources represent economic benefits when they are settled in the future. No business is going to take on a liability unless it has some sort of benefit to the business. Now, liability is made up of these three main characteristics. It's a present obligation. That means that the business must have done something to have incurred the liability, and they owe someone or some other business or a government department perhaps an amount. Now, the liability represents an outflow of resources, and that outflow of resources represents economic benefit. So this means, how will the liability be settled or paid? Which resource asset is going to flow out of the business when the liability is settled? Will it be a cash payment or will it be something else? And a past event. This is how the entity came to have the liability. And again, this is pretty easy. The business took out a bank loan. The business engaged in taking out a bank overdraft.